Here's the thing. If I gave you a choice right now, put your money in a fund that charges you 1% every single year, or put it in a fund that charges you 0.03%, which would you pick? Most people would say the cheaper one, and most people would be right. But here's what's crazy. Almost 70% of Americans are paying the higher fee, and they're doing it even though the actual, proven, undeniable evidence, tells us they shouldn't be. So in the next few minutes, I'm going to show you exactly why Warren Buffett, the single most successful investor in modern history, has repeatedly told people to stop trying to beat the market. And more importantly, I'm going to show you the 3 ways index funds can change your financial future. The last one, nobody talks about it, but it's the reason Buffett keeps winning. All right, let's get into it. The first thing you need to understand is what an index fund actually is. Here's the simple version. An index fund is a basket. Inside that basket are hundreds, sometimes thousands, of different company stocks. And that basket is designed to match a specific market. The most common one tracks the S&P 500. That index includes the 500 biggest companies in America. We're talking Apple, Microsoft, Amazon, JP Morgan, all the names you know. When you buy an index fund, you're not betting on one company. You're betting on all of them at once. And here's why this matters. When you invest in a single stock, you're taking a real risk. That company could fail. It could get disrupted. It could face a scandal. You lose everything. But an index fund, it spreads that risk across 500 companies. So when one company has a bad quarter, it barely moves the needle. Now here's the part nobody tells you. The average actively managed stock fund, the kind where a professional manager picks individual stocks, charges around 1.1% per year. Some charge 1.5. Some charge 2. Index funds, they average around 0.1%. Some are as low as 0.03. Let that number sink in for a second. Over a 20-year period, that difference can mean hundreds of thousands of dollars in your pocket instead of your broker's. And it's not just about fees. This is where it gets interesting. You've probably heard the phrase beat the market. Investors talk about it like it's the holy grail. Find the right stock, pick the right fund, outsmart everyone else. The problem? It almost never works. A study by Standard & Poor's looked at 15 years of fund performance. They found that over that entire period, 87% of actively managed funds underperformed their benchmark index. 87%. Let me say that again. Almost 9 out of every 10 professional money managers couldn't even match the market they were trying to beat. Why? Because it's genuinely hard. Human beings get emotional. They buy when things look good. They panic when things look bad. They make decisions based on headlines instead of fundamentals. The fund manager gets scared and sells at the wrong time. The fund manager gets greedy and buys at the wrong time. Meanwhile, the index fund just keeps holding. It doesn't panic. It doesn't get greedy. It just tracks the market steadily year after year. And that steadiness, it adds up. Compound interest is the most powerful force in investing, and it works best when you don't interrupt it. Okay, so now you know why index funds work and why active management usually doesn't. But here's what I really want you to understand. The thing that actually makes this strategy unstoppable. This is the part most people miss. Warren Buffett knows all of this. Obviously, the man is worth over $100 billion. He didn't get there by accident. So in 2007, he made a bet. He wagered $1 million that an index fund would outperform a collection of hedge funds over 10 years. A hedge fund is basically a private investment club for rich people. They charge huge fees. They use complex strategies, and they promise big returns. Buffett said, put your money in a simple S&P 500 index fund instead. The people who took his bet were Wall Street professionals. These were not amateurs. They were running sophisticated strategies with teams of analysts and years of experience. 10 years later, the index fund returned over 125%. The hedge fund collection, it returned less than 40%. Buffett wasn't even close. He won in a landslide. And here's the part that matters most. He didn't just win money. He proved a point that millions of people still refuse to accept. You don't need to be a genius. You don't need secret information. You don't need to spend hours every day watching the market. You just need to pick a simple index fund, invest regularly, and let time do the work. The math takes care of itself. So that's the game. Low fees, broad diversification, time on your side. If you want to start investing and you don't have the time or the desire to become a full-time stock picker, index funds are the move. But here's the thing. Most people still won't do it. Not because they can't understand it, but because they think they can do better. And maybe they can for a little while, but the research is clear. The fees are real. The underperformance is documented. And time is the only advantage that matters in the long run. So the question is, do you want to play the game where the odds are in your favor? Or do you want to keep paying for the ones where they're not? If this video made sense to you, share it with someone who's been paying high fees for years without knowing why. Hit subscribe if you want more videos like this. I'll see you next time.